What if the biggest economic disasters in history weren't just disasters? What if every crash, every recession, every financial panic you've ever heard about carried a hidden function? Because here's something strange. Every time the global economy collapses, ordinary people lose jobs, savings vanish, and businesses disappear. But, at the exact same time, new financial systems emerge, new rules are enforced, and power quietly shifts upward. So the real mystery isn't why crises happen, it's why, after every crisis, a system becomes more centralized, more controlled, and more powerful than before. Coincidence or design? To understand this pattern, you have to stop thinking of money as just currency. Money is influence. Who controls money? Controls decisions. Who controls decisions shapes the future. And modern economies are not simple systems. They are layered networks of governments, banks, institutions, and global agreements, all connected by one thing: debt. Debt is the engine, not wealth, not productivity. Debt, because in today's system, money is created when debt is issued. Loans become currency. Credit becomes reality. That means the more debt exists, the more the system expands. But here's the catch. A system built on debt must keep growing. And when it can't grow anymore, it breaks. Let's start with one of the most devastating financial events ever recorded: the Great Depression. In the 1920s, the United States experienced rapid economic growth. Stock markets surged, credit expanded, people borrowed heavily to invest. Everything looked strong. But underneath that growth was instability. Banks were loosely regulated, loans were risky, and speculation was everywhere. Then, in 1929, the crash happened. Markets collapsed, banks failed, millions lost everything. But here's where the pattern begins. Out of that destruction came transformation. Governments didn't just respond, they restructured the entire financial system. New regulations were introduced. Central banks gained more authority. The role of government in the economy expanded dramatically. Before the crisis, power was scattered. After the crisis, power became more centralized, and most people didn't question it because they were too busy surviving. Now fast forward to the aftermath of World War II. The world economy was in ruins. Countries were bankrupt, infrastructure destroyed, trade broken. Another crisis, another opportunity. In 1944, a meeting took place that would quietly shape the modern financial world: the Bretton Woods Agreement. At this conference, global leaders designed a new financial system. Currencies would be tied to the US dollar. The US dollar would be tied to gold, and new institutions would be created to oversee global finance. The International Monetary Fund, the World Bank. These weren't just organizations. They were mechanisms of influence, because countries in crisis would now depend on these institutions for loans and recovery. And with loans came conditions, policies, reforms, structural changes. In other words, economic crises became entry points for external control. And once again, the pattern held. Crisis gives dependency, gives restructuring, gives centralized power. But even this system didn't last. By the late 1960s and early 1970s, something was wrong. The United States had printed more money than it had gold to back it. Confidence began to weaken. And then, in 1971, a silent but massive shift occurred. The gold standard was abandoned. The US dollar was no longer tied to anything physical. Money became purely symbolic. This was one of the biggest financial transformations in history. But it didn't happen during civility. It happened during economic pressure, inflation, war spending, and global imbalance. Another crisis, another reset. And this time, the implications were even bigger. Without gold as a limit, money creation could expand indefinitely. Debt could grow faster than ever. Financial systems could scale globally. But it also meant something else. Control over money became more abstract and more powerful. From this point forward, crises didn't disappear. They multiplied. 1980s debt crises in developing countries, 1997 Asian financial crisis, 2000 dot-com bubble, and then 2008 the global financial crisis. This was not just a recession. It was a near collapse of the entire financial system. Banks had created complex financial products based on risky loans. Housing markets were inflated. Debt was everywhere. When it broke hard. Trillions of dollars were lost. But look closely at what happened next. Governments didn't let the system collapse. They intervened. Banks were bailed out. Interest rates were slashed. Money was created on an unprecedented scale. Quantitative easing, liquidity injections, emergency lending. The system didn't end. It evolved. And once again, power shifted. Large institutions became even larger. Central banks gained more influence than ever before. And the gap between those who control assets and those who depend on wages widened. Here's the part most people miss. After every crisis, solutions are introduced. But those solutions often create the conditions for the next crisis. Lower interest rates encourage more borrowing. More borrowing increases debt. More debt increases fragility. It's a cycle, but it's not random. Because each fix also strengthens the system's core structures. More regulation, more centralization, more reliance on institutions. It's like reinforcing a building after each controlled demolition. Now look at today. Global debt has reached historic levels, over $300 trillion worldwide. Governments, corporations, and individuals are all deeply tied to debt. Inflation is rising in many parts of the world. Currencies are under pressure, and new ideas are emerging. Digital currencies, central bank digital money, cashless systems. At first glance, these look like innovation, but through the lens of history, they look familiar. Because every time the system faces pressure, a new layer is added. More control, more tracking, more centralization, and always introduced during or after instability. So let's connect the dots. Crises create fear. Fear creates urgency. Urgency allows rapid change. Rapid change restructures systems, and those systems concentrate power. This doesn't mean every crisis is planned, but it does mean every crisis is used. Used to push boundaries, used to introduce new mechanisms, used to reshape how money and therefore power flows. 1. Economic crises are not just failures, they are turning points. Every major collapse in history has led to structural changes in how the world operates financially. 2. Power consistently becomes more centralized after each crisis. Whether through central banks, global institutions, or financial policies, control tends to consolidate, not disperse. 3. The solutions to crises often set the stage for future crises. The system doesn't eliminate risk, it transforms it and moves it forward. So here's a thought to leave you with. If every crisis reshapes the system, and every reshaping increases control, then what will the next crisis create? A more stable world, or a more controlled one? Because history suggests something uncomfortable. The system doesn't just survive crises, it grows stronger because of them.